COVID-19 has brought about such a huge impact, both on the way we're living our lives at the moment and on financial markets. And those two impacts are really hand in hand. What we've ultimately seen is the genesis of a medical crisis, originating in China first, then develop into an economic crisis as governments around the world really sought the best way to minimize the impact of the rising pandemic. And what we've seen is effectively the global economy for the first time ever be put into hibernation so that we can try and move past the medical crisis with the hope that we can then transition and deal very effectively with the economic crisis. Over the quarter, we've seen markets exhibit a fair amount of volatility, and ultimately it's been a quarter of two halves. We saw a very nice, gentle start to the year with markets ticking up very, very calmly to right up until February 20th. And whilst COVID had been around since November, you'd see reports coming out of China as far back as November, markets had really seen that as a China-centric issue up until about February 20, which was the peak before we saw the sell-off. And a confluence of events, confluence of things came about over that period, but ultimately markets really started to take them seriously between February 20 and March 23. And that's where we saw the white heat of the sell-off. And so, but by the end of the quarter, despite some equity markets being down more than 30% over the quarter, we saw a little bit of strength come back in, and we saw markets close approximately 20% down on the year. As we watched the markets respond to the developing situation, we saw an indiscriminate sell-off across asset classes, across sectors. So energy is probably the standout. The Australian energy sector as a whole fell by almost 50% over the quarter. The RBA cutting the rate actually to all-time lows. So both times it cut was 25 basis points, or a quarter of 1% each. And that's good and bad. And I guess on the good side, it's important because it means that the RBA, the Reserve Bank of Australia, our central bank, is taking the situation very seriously and is stepping in and providing monetary support for our economy. On the bad side, it means that they recognize that the economy is in need of that support. Looking at where investment markets go from here and when the recovery comes is I guess with inflation, it's not even $1 million question anymore. It's probably $1 billion question. But ultimately, it's very hard to know. What we need to see on the one hand is the medical crisis to fade, which we're starting to get early indications that that's beginning to happen. And then the next step is the economic impact. And we've seen tremendous support by governments around the world in terms of putting fiscal support in place to have the economy healthy enough to reboot once it gets to that stage. But at the moment, it's a matter of wait and see. It's very obvious what the first order impacts are, in the sense of, we've got travel dropping, we've got hospitality being heavily impacted. But then you've got the knock-on effects, and when we get to second and third iterations, almost by definition, nobody can foresee what they are. And I think we're already seeing from governments, whether it be in the US or Australia or Europe, are already sort of behaving in a way that suggests that they're going to be very dynamic over the coming 6 to 9 months. I think we'd all like to hope that things are well on the way to being restarted and getting back to a normal rhythm by the end of 2020. But then bearing in mind from a market's point of view, markets broadly look 12 to 18 months out ahead. And admittedly, whilst the visibility at the moment is very low, we don't necessarily need everything to go back to normal for market prices to start getting back to normal levels. Over the last year or so, what we've been finding is whilst there have been managers out there raising money, there hasn't been anywhere near as much managers drawing on the money that they've raised, meaning that they're not finding enough suitable opportunities. In an environment like we've seen, what you tend to find is either distressed sellers, people who desperately need to raise money from an asset they're holding, and that draws attraction from an alternatives point of view, or you just had some special situations arise. And what we've actually been seeing across our book is the managers we deal with actually drawing down on those cash commitments quite heavily. So what that's telling us is that they're out there seeing a lot of good opportunity. As you get closer and closer to retirement, your ability to bear risk, as in market volatility, like we've seen, becomes lower because that end value of your super fund or your pension fund, however it's denominated, is really key for you. The main thing is to basically stick to the plan. Hopefully you've got a good solid plan in place. Most investors in times like this throw away value by overtrading. And it's this feel that something's going on out there, therefore I need to adjust, I need to make changes. Most of the time that's not the case. Big studies that are done of investor behavior in times like this shows that overtrading ultimately destroys value.